All right, guys, welcome back. Part 3 of episode 1, Road to Success. So, we're going to talk about everything you need to know when buying your first home or buying a home in general.
Yeah, no, absolutely. And I feel like a lot of the times people want to buy a home. What's the first thing you do? You're going to be like, oh, Andrew, of course. You pick up your phone and you call your realtor. Wrong. Generally, that is what a lot of people do. And that's why we work hand in hand with realtors and different referral partners. Everybody says, oh, I want to buy a home. Let me call a realtor because that's who's going to get me in the door. The first thing the realtor should tell you and will tell you more than likely is, hey, you got to get pre-approved. You need to talk to a loan officer before I can start showing you houses, anything along those lines. So not saying that, hey, it's a terrible idea to call that trusted realtor you know and love first, but the actual first step to buying a home, whether you're a first-time buyer or this is your second, third, fourth, fifth, eighth property, doesn't matter. You need to get pre-approved by a loan officer.
Right, because if you're already have a home and you are like, hey, let me sell this home and then go and buy another home, right? Well, you're like, hey, I just went under contract, but I didn't get pre-approved. Oh, snap, I did something in the last couple of years that now disqualifies me from buying my next home. Now I'm already under contract on the old home, and now you're in hot water because you're like, I guess I'm going to have to rent, right?
Yeah, and, a good real estate professional won't get you under contract or accept a contract without a pre-approval letter. Or if you're paying cash, proof of funds is another thing they look at.
Yep.
But, I would say first-time buyers, a lot of the time, I deal with many of them, some of my favorite type of clients out there, because everybody kind of walks into this thinking, oh, it's so daunting, there's so much going on, it's so difficult. But really, and it goes back to being, hey, we're normal people too. I always try to break it down in layman's terms as easy as possible. Answer any questions you have, dispel any rumors. There's a lot of rumors around there, or kind of people thinking, oh, I need 20% down, or I heard this, or I heard that, or what about this program, and what about that? That's what we're here for. Here to kind of explain everything in layman's terms, break it down for you, put you at ease.
Right. So I think the first part is understanding your income. So a lot of people don't know that we, as mortgage professionals, we need to, look at those documents. And if you just started a company this year, I'm sorry, but you're not going to be able to get a traditional mortgage.
Yeah, no, absolutely. And I mean, before we kind of dive into that, we should probably go back to the Trinity there, as I always like to call it. Mm-hmm. When you're buying a house, when you're applying for a mortgage, there's 3 things we look at first. The first and foremost is credit. We're not only looking at the credit score, we're looking at all your liabilities. We're looking at credit history, credit profiles, maxed out cards, how long you've had certain lines of credit open, different things along those lines.
Yeah, it's not just, but I have a 700 credit score. I should be able to qualify for a home.
Exactly.
That's not it. That's not everything, right? We have to see, do you have lates? You could have a 700 credit score and have a late.
Yeah,
right?
Late
do
payment.
you have bankruptcies?
Yeah.
Right? Did you get repossessed on a car? Do you have collections? Do you have medical bills? Right? So all these things are going to play into fact, and just because you have a 700 or whatever the score is doesn't mean you're going to get approved, right?
Exactly. And I think, starting with credit is because it is kind of the most important there. That is the first step. That's why I kind of put him up here, pillar 1, credit. 2, we get into income.
And before we get into income, I'd love to say, because some people, for example, follow the philosophy of like Dave Ramsey, of like, oh, I'm not going to have any credit cards, right? And I can buy a home that way. It is true, you can get a home without having credit, but something that they never say is, guess what? You're going to have a higher interest rate.
Yeah, and different terms as well.
And different terms. It is not going to be the same as someone who has credit and they're qualifying with their credit. So, love the philosophy for some people, right? Some people can't handle credit cards, right?
Yeah.
But listen, this is the world we live in. Banks want to know that you're trustworthy. That's where credit comes from.
Exactly. And I think with credit cards too, I mean, it's not just credit cards that'll give you a credit score. Student loans. Yep. I mean, if you ever had any car loan, anything along those lines, personal loans, all kinds of different things give you a credit score. But credit cards are important, I feel, but they can be dangerous. So it is kind of a fine line. You have to use your credit responsibly, not maxing it out, paying it on time every single time, not. And in turn, you know, hey, let's say if I have this credit card and it's got $1,000 limit, and I go out there and I buy about $200 worth of things. I used to like to say a trip to the grocery store, but $200 might not get you a full
Not
trip
anymore.
to the grocery store anymore.
Not anymore.
But yeah, I mean, pay it off in full every month. What that's going to do in turn is you're responsibly using that credit. I'm not maxing it out, keeping it at a low amount. I'm paying it off in full every month, and it's going to kind of start helping you.
Yep.
But again, you know, I feel people like Dave Ramsey and different things like that, you see so many horror stories about debt and people getting into it. It's easy to get down that path if you're not intelligent with your credit.
Yeah, 100%. You have to take care of it, right? And I think the first step is being taught how to, right? Which is, like we said, making sure you make the payments on time. That's it. I mean, you can make the minimum payment, but as long as you made at least the minimum payment, you're okay, right? If you go into debt a little bit and then you have to get out because life happens, now we also would always advise to have an emergency fund. But, you know, some people just aren't there yet, right? But credit is 100% the number one thing, and you have to take care of it, and you should definitely be teaching your kids about it. And one little tip that I can give people is that if you have a kid, add them to your credit card. And authorized user. Get them a credit card as soon as possible. I think some banks do like 14 or 16. Some banks do 12, right? It's just a little different.
Yeah.
That right there is just going to set them up for success. Because when they go out and they get student loans or they get a car loan or they go out and get credit cards, right? Now they have a leg up. They've already started. And if you can teach them how to use it, that right there, that's a strong step for them becoming an adult.
Exactly. And to touch on that, though, if you guys do come to us and you're like, hey, look, I've never had credit in my life, but I am an authorized user on my mom's card, and it does give me a good credit score, you're going to want a little more credit than just that because it's not true credit, if that makes sense. It's going to have a good effect on your score. It's open up a lot of doors with student loans, car loans, credit cards, different things along those lines. But we look pretty in-depth with the mortgage on the credit. But that kind of, you know, goes back to how I consider myself. I know you consider yourself the same way. Is, you know, this isn't just a regular mortgage transaction. We're less concerned about, hey, here's the house, here's your mortgage terms and everything like that. I always try to take a look at the big picture, all your finances.
Right.
You know, hey, does this make sense? You know, I'm never going to say, a lot of people always ask us, hey, what's the max I'm approved for? And that's kind of where I steer them away from that because hey, you might be approved for that, but what's the max that you're comfortable spending every month? Because let's not forget, this is just including the mortgage payment. That includes your principal, interest, your taxes, your insurance, any mortgage insurance, if that's on there as well.
Right.
That's not including any utilities, water, gas, electric, trash, if you pay for that in your area.
Oh, yeah.
So, you know, it's just something to kind of take.
We're not trying to just get you in the door and then say, bye, Felicia, you got a home. You know, like we really want to make sure that you're set up for success too. That's why we ask those questions like, all right, what do you want your maximum payment to be? And if you go, well, I want a $300,000 house, well, that doesn't tell us much because at $300,000, you could have very drastic different prices. You know, you could have a home that has an HOA fee that's by the water, right? You could have a home that is in a neighborhood where the taxes are super low or super high. So that's where the important question comes in. What do you want to pay as your maximum, right? What is the maximum payment that if you had to go above that, you just wouldn't feel comfortable, right? And that's, I feel like, the number one question when we're talking to a buyer and trying to make sure that we steer them in the right direction.
Yeah, absolutely. And that's why we asked that question as well, because there's so many times that, like he said, oh, I want a $400,000 house. I thought about this, thought about that. Well, what do you want your monthly payment to be? Well, probably like $1,500, $1,600 a month. might not be looking at a $400,000 house for
Right.
that amount there, unless you had a rather large down payment. But
Right.
so that is important, I feel. And that kind of wraps up the most important thing is credit, you
Right.
know, what you can afford, and determine what you can afford. We get into income.
Yep.
So with income, I mean, we have credit first. That's the first thing we look at. Then we go to income. Tons of different types of income there. I will say when you're qualifying for a mortgage, we use your gross income, not your net income. So that is pre-taxed. The only kind of stipulation to that is if you are self-employed, then we do have to use the tax returns, see what you're paying taxes on, everything along those lines. But typically, if you're a W-2 borrower, what we like to see is 2-year job history. We go through kind of line of work, everything along those lines. We'll get your pay stubs. We'll get your W-2s. We'll calculate the income properly. We'll see if you're salary, if you're hourly. And that's how we kind of determine, hey, we already have the credit over on this end of things. Now we have all your income information. And that's kind of how we can determine what your debt to income is and go back and kind of compare that. And then we're also taking into consideration your future debt, meaning the housing payment as well. And that's how we come up with debt to income, aka DTI. And that's how we really can determine ratios and different things like that for if you actually do qualify for a house that amount after the credit step.
Right. So since we're talking about employment, you know, what incomes can we use, right? If you just started a business, like I was saying earlier, and this is your first year reporting taxes, it's not going to happen. Now, caveat to that, there are some loans out there that will. However, just know that they do come with higher interest and higher down payments. So there are programs out there, but we're talking about traditional mortgages, the regular day-to-day stuff. So that right there, you would not be able to do, right? If you just started a second job and you think that, hey, I have this second job, now I can use that income to qualify for a home,
Can't do that either.
Can't do that. Can't do that.
Yeah.
So you need to have 2 years proving that you have 2 jobs or that you have overtime or that you receive a bonus or receiving commission. Basically, the way I like to think about it is if it is not salaried or hourly, 40 hours a week, which is the normal, then we need 2 years to prove it. Because, listen, most normal people, and I know a lot of people do work more, but most normal people, it's 40 hours a week, that's it, right? So if you're doing anything other than that, if you have your own business, if you're getting commission, all those other things, we have to see 2 years. And that's not us. It's not like Andrew and me. We're like, hey, Andrew.
I'd like to see 2 years on this guy. Come back.
Let's make sure everyone gives us 2 years. And if they don't, you know what? We're not going to give them a home.
Yeah, we don't want them.
Yeah.
Nah, they're guidelines, guys. I mean, that's what an underwriter's looking for. That's, you know, a big part of their job is those are the guidelines to apply or rather qualify for a mortgage. And Viali did touch on it well. We are looking for 2 years job history. Overtime, you can kind of get away with a little less sometimes, but in general, if you have any special pay, anything along those lines, they're going to want to see 2 years history of that. Same with the second job, because so many people are out there like, oh, well, hey, I heard that my DTI was too high. I met with the loan officer, my DTI is too high. I'll just go pick up another job just to qualify for this mortgage. That's kind of the whole reason that guideline exists. You need a 2-year history of working 2 jobs to use both incomes.
And listen, guys, all these rules are in place because the United States is the only country in the whole world that has 30-year fixed mortgages. And the government backs them up. That's why they made these rules. They are the ones that if, you know, shit hits the fan, they are the one that foots the bill, right? Yeah. That's what happened in 2008. Whoops, they messed up, made a whole bunch of rules now that made it hard for us, but it's trying to prevent the economy from something happening like that again. And that's why those things happen, and that's why those rules are in place. If you go to any other country, Canada, Europe, any other place, no, I just said a continent, so don't.
Yeah.
But
Europe, my favorite country, Europe.
Europe is my favorite country. That's my favorite place to go. So if you go to any of those countries, it's gonna be an adjustable rate mortgage.
Yeah, sometimes, and they do have some fixed rates, but a lot of the times they're not going to have down payment options. A lot of different countries still are
20%.
10 or 20% down. So we do have a lot of options over here. And like you said, since 2008, a lot of different rules going into effect. Checks and balances is really, hey, somebody messed some things up pretty heavily there. We're
Whoops.
going to make sure this never happens again.
My bad.
Exactly.
I didn't mean to give you a mortgage and you didn't make no money.
Mm-hmm.
That's what happens. So, boom, talked about
yeah.
assets or talked about income.
Credit, income, 3, assets. Show me the money.
Show me the money.
So, yeah, I mean,
What
assets is just what's in your bank account. Couple different things.
I have some money in cash. Can I use that? Wait a minute.
We get that a lot. Mattress money, we look to see 2 months bank statements on everything. You want to see seasoned funds. You want to make sure it's coming from a legit source. Now, that's not to say, hey, I only have, a couple $1,000s in my bank account. I can't buy a mortgage. Don't get scared away. It's just what we look for is how much do you have? Where's the source of those funds? If we see, hey, you got $5,000 in your bank account, and we see that you made a cash deposit at the local M&T Bank or Wells Fargo, $5,000 in cash, the underwriter's going to have some questions on that. It's unverified funds, unsourceable funds. It came from money, hey, where'd that money come from?
And again, that goes back to making sure that all these transactions are reputable, right? They don't want, Joey the drug dealer to be putting his money into the bank and then we don't know where the money comes from. Then he goes and buys a house because he did his taxes. Good on Joey, by the way. And next thing you know, the government finds out that he's a drug dealer, and then we have to foreclose on the. Well, we don't.
Yeah,
we don't.
Not technically our job, but
yeah, it's not our job. That's a different department.
Yeah, there's checks and balances with everything, but touching on that is usable source of assets, your checkings accounts, your savings accounts. I mean, some people 401ks, retirement accounts, different things like that. Now, I won't say that it's the most common unless you're of age to withdraw from your 401k and you are old enough to do that without, taxes or fees. Some 401ks and retirement companies will let you allow to withdraw early due to, I believe it falls under hardship reason. Yep. Buying a house, sometimes they consider that a hardship. But everyone is different. You always want to check with your retirement, whoever holds the retirement account, 401k, IRA, anything along those lines.
Yeah, because not all of them are going to let you take out the whole thing.
Yeah,
right?
or fat taxes and fees too,
Right.
You're going to take some out and you're going to be paying a lot of money to remove that early withdrawal.
That's a good thing for you, for you guys to know that if you're going to take out money for your 401k to buy a home, you need to touch base with them and make sure you have that information. Because if you're going to get taxed, you need to make sure you're making the right moves with your money.
Exactly. And how much you can take out. Everyone is different, though, when it comes to that. So, other usable funds. I mean, gifts sometimes, if they're coming from a relative, a family, anything like that, maybe you're a little short. Maybe it's one of those things that your parents are like, hey, get out there, buy a house. We've had this fund set aside for you for a long time. We'd like to give you this money to buy a house. Yeah, parents can give.
I want those.
Yeah, exactly. But that's usable source of assets. We just goes a little bit behind the scenes on how we have to document that, fill out a gift letter, see the transaction going from account to account, and source and verify the funds. But that is a common one. I see a lot of gifts out there, especially if somebody's a little bit low cash to close, and some parents out there, give large amounts to buy a house.
Right. Yeah.
And then the other one I want to touch on is what is fairly common, not necessarily for first-time buyers, but people that are selling a home and buying a new one. Future net proceeds from a real estate sale. We see that all the time. I mean, I have borrowers out there that, hey, we're not even really technically need their bank statements because they're selling their house. This is how much they're getting off of that house, and this is how much they're applying to the cash to closing cost down payment of this purchase.
And I feel like that's a really, really good segue into the market.
Yeah.
And whether people should be buying right now Should they wait? What is it gonna do, right? So, for us, I feel like we're always saying, especially right now, this is a great time to buy.
Yeah.
Great time to buy. Other people are gonna tell you, well, interest rates are high. I don't
Yeah.
want to buy when interest rates are high, but they don't matter. Interest rates don't matter. You can change them at any point in time. The only thing you can't change is the price you bought your home for.
Exactly. And, it goes back to that old adage that grass is always greener on the other side. I've had so many people that during 2020 and 2021, where rates were at historic lows, prices were hyperinflated. People are just, I'm going to wait this out. I'm going to wait for that market to cool down. Well, guess what? Market may have cooled down a little bit, but rates really took a hike as well. And I guarantee you all those people are kind of kicking themselves. I mean, I know for a fact some of the people I've spoken to are just like, I really should have bought when you pre-approved me the last time, but I didn't, and I dragged my feet, and yet here we are.
Now prices are higher, interest rates are higher. Look, when's the best time for you to buy a home? 5 years ago.
Yeah, exactly. Exactly, because you can always build equity on a home and different things like that. But
Yeah,
to kind of go into the market a little bit is, it's still very crazy out there. You'll know this if you are pre-approved, if you are out there shopping for homes. It's very area dependent, I feel. Yeah. But popular price ranges, popular counties and stuff, you're still having these houses that, hey, we got 12, 15, 20 offers on when it goes time to take a look at everything. So It is very competitive out there, which brings me back to, hey, that's why your real estate agent wants you working with a local trusted lender.
And you get 2 offers. If I'm a seller, right, I get 2 offers. I get local lender, Andrew, the Mad Dog Bulldog, and I get Joe Schmo from Bank of America. Sorry, Joe.
I know Joe. He's a decent guy.
He's a good guy.
A decent guy.
There's nothing wrong with Joe. But listen, Joe sometimes doesn't review all the documents.
Yeah.
Joe sometimes, he does a good job, but he's also not available weekends.
Yeah. And let's say that offer's due on a Saturday, and that listing agent wants to do their due diligence and speak to that loan officer, make sure, hey, we got that feel-good feeling there.
Right.
If Joe doesn't answer, that's going to be an issue.
Right. And something that we do, right, that some people, and, to each their own, is we send out pre-approval letters with the address of the home. Because we will check before you send out every single offer, do you qualify for this one? Because on something that we talked about before is that home could have an HOA fee. It could be by the water.
Taxes are always different as well.
Yep. You could be in the same neighborhood and you could have someone that's paying $5,000 and someone who's paying $3,000 a year in taxes.
Yeah, exactly.
In
It
the
all
same
depends when
neighborhood.
the county assessed it, but
Exactly.
and that's what we always try to do. I know I do it. I know you do it the same way. Is when making an offer, I always try to beat that listing agent to the punch. I call them as soon as that offer's in, just to say, hey, this is Andrew. Got my pre-approval with such and such realtor on your listing at whatever the property is, and just kind of go over everything. Hey, just want to put you a peace of mind. These are how these borrowers are looking, well qualified for the house, everything like that. Every once in a while, I will say there are some listing agents out there that are quick on that trigger because they'll beat me to the call, and it kind of hurts my pride a little bit. I'm like, I was just about to call you.
Right.
But it's good because it's showing they're doing their due diligence, and I always like to do my due diligence.
Exactly. I mean, look, the offer just looks stronger if it doesn't say TBD, to be determined, right? Like, all right, did they even look at this house? Like, and that could be scary because, like, what if that house does have super high taxes that are abnormal? And that's something we verify, right? We want to check. Some counties are a little bit harder than others to verify that, but we try to do our due diligence and make sure that it doesn't. And those are some things that, for some people, I mean, shoot, if that tax assessment was super high, and instead of it being the normal of like $4,000 or $5,000 for that area, if it's 8 or 10, they might not qualify anymore.
Oh, absolutely.
So that's why it's super important to make sure you're working with a reputable lender who's double checking and that the numbers. Like, you're not just putting in an offer on this house and all of a sudden, oh, wow, I need $2,000 more than what I thought before because of whatever's going on with this home, right?
Exactly.
So
And that is one thing I'll say. You know, Maryland is less extreme when it comes to property taxes for, you know, hey, we have two houses here. They're both 300,000. They're both in generally the same area. Typically your property taxes are going to be pretty close, but both of us are licensed in Pennsylvania, and that's a whole different ball game up there.
Oh, yeah.
I mean, you can have both the same houses different by, you know, $2,000 worth of property taxes, school taxes in a year. So it's always too important to double check. That's kind of how we both handle our business, though. You know, hey, I always like to estimate on the high side. Hey, you're looking for X purchase price in X county and X state. This is generally what you're going to be looking for. But what I always like to tell my clients is when you go to look for something, give me a call. Shoot over that property. I'll run the numbers for you. We know exactly what we're getting into.
Right. So, I mean, at this point, they know about credit, they know about income, and they know about assets.
Yeah.
I feel like right now you should be more informed than sometimes a lot of realtors out there.
Yeah.
So
at times. And those are the main things we look for there. Now, there are a lot of other things. That's us on the first level as a loan officer. When it comes into underwriting, I mean, I could sit here for the next 3-4 episodes talking about guidelines and underwriting and different things like that. But
a genius, I'm telling you. Like, he's like an encyclopedia. Like, you
got to remember
what's
it.
This?
I got a philosophy in life. Look, there's no stupid questions. Do your best not to ask the same question twice.
Unless it's me, then I ask a lot of stupid questions.
Yeah, but you do your best not to ask the same thing twice. And when you do, I call you out on it every time.
Oh, man. So now you guys know everything that you need to know when you're a first-time home buyer, exactly what to do to prepare, right? So working on your credit, making sure your income's on point, knowing what budget you want to be at, and where your assets need to be. What can we use? What can't we use? If you guys have any other questions, put them in the comments below. Reach out to us. Subscribe. Comment. The whole.
Call me, beat me, reach me. You know, Kim Possible.
Oh yeah. I knew it already. All right. So, all right, guys. Appreciate you tuning in. Episode 1 is to a wrap, and see you guys next time.